Two brand-new commercial jets fell from the sky within 5 months of each other, taking 346 lives and shattering a century-old legacy of aerospace dominance. The immediate culprit was a flawed line of code, but the true cause was a quiet, decades-long shift in how one of the world's most respected manufacturers measured success. To understand how a machine designed for absolute safety became a symbol of catastrophic collapse, you have to look past the wreckage and examine the invisible forces of the market. The tragedy of the 737 MAX was not simply an accident, but the predictable output of a system that incentivized speed over certainty. In the early 2010s, Boeing found itself facing an existential threat from its primary European rival, Airbus. Airbus had just announced a highly fuel-efficient update to its flagship narrow-body jet, capturing the attention of major airlines desperate to cut operational costs. American Airlines, an exclusive Boeing customer for over a decade, signaled it was ready to defect and place a massive order with the European competitor. Panic set in at the corporate headquarters, forcing executives into a corner where they had to deliver a competitive alternative almost immediately. The luxury of spending 10 years and $30 billion on a clean-sheet airplane design was entirely off the table. The most economically viable path was to modify the existing 737 airframe, a workhorse design that dated back to the 1960s. By strapping larger, more fuel-efficient engines onto this older skeleton, the company could deliver the promised fuel savings without the massive capital expenditure of a new build. However, the larger engines fundamentally altered the aerodynamic physics of the plane. They had to be mounted higher and further forward on the wings, which created a tendency for the nose of the aircraft to pitch upward during certain high-angle flight maneuvers. This physical reality threatened the one selling point the manufacturer needed most. If an airplane handles differently than its predecessor, aviation authorities require pilots to undergo extensive, highly regulated simulator training before they are allowed to fly it. Simulator training costs airlines millions of dollars and takes pilots out of active rotation, making the new jet a far less attractive purchase. The corporate mandate was absolute. The new MAX had to handle exactly like the older models, requiring nothing more than a brief digital training course on a tablet. The financial success of the entire program hinged on avoiding that costly simulator requirement, creating immense pressure on the design teams to solve a hardware problem with a digital patch. To force the new aircraft to mimic the old one, engineering teams developed a piece of software known as the Maneuvering Characteristics Augmentation System, or MCAS. This background program was designed to automatically push the nose of the plane down if it sensed the aircraft was pitching up dangerously close to a stall. In theory, it was an elegant solution to an aerodynamic compromise, allowing the manufacturer to keep its promise to the airlines. The software would operate silently in the background, intervening only when necessary, and theoretically requiring no special attention from the flight crew. But the implementation of this software violated fundamental principles of aerospace design by introducing a single point of failure. MCAS relied on data from only one angle of attack sensor, located on the outside of the fuselage, completely ignoring the second sensor installed on the opposite side of the plane. If that single sensor malfunctioned and fed erroneous data to the flight computer, the software would assume the plane was stalling and violently force the nose down. There was no redundancy built into the system to cross-check the data, a glaring oversight in an industry where backup systems are a foundational requirement. The decision to omit redundancy was compounded by an even more dangerous choice regarding the flight manuals, because acknowledging the existence of this powerful new software might trigger the dreaded simulator training requirements. The company actively minimized its presence in pilot documentation. When pilots stepped into the cockpit of the new jet, they were completely unaware that a background program possessed the authority to override their manual inputs and force the aircraft into a dive. The financial incentive to seamlessly transition pilots had entirely superseded the operational necessity of keeping them informed. This chain of decisions highlights a profound shift in engineering ethics within the company. For decades, the manufacturer was run by engineers who operated under a culture of rigorous safety and technical excellence, where technical experts had the final say on design choices. Following a major corporate merger in the late 1990s, the leadership shifted toward financial executives who prioritized shareholder returns, stock buybacks, and relentless cost-cutting. The balance of power moved from the drafting tables to the executive suites, fundamentally altering how risk was calculated and managed. You might wonder how such a critical system bypassed the rigorous scrutiny of federal aviation authorities, specifically the FAA. The reality of modern aerospace manufacturing is that the government simply does not have the manpower, budget, or technical expertise to inspect every single line of code or structural rivet on a modern commercial jet. Over the decades, legislative mandates had continuously forced the agency to rely on a system known as Organization Designation Authorization. Under this framework, the regulator delegates the responsibility for safety certification back to the manufacturer's own employees. This system essentially allows a corporation to regulate itself, creating an inherent conflict of interest. The company employees tasked with certifying the safety of the new jet were ultimately paid by the very corporation pushing them to meet aggressive production deadlines. When engineers raised concerns about the lack of redundancy in the software or the pace of development, they were often met with hostility from management. The regulatory capture was so complete that the agency signed off on the final design without fully understanding the sweeping authority the new software had over the aircraft's flight controls. The intersection of corporate competition and regulatory capture created an environment where systemic vulnerabilities were actively concealed rather than addressed. The agency trusted the manufacturer's assurances that the software was a minor background function, while the manufacturer leveraged that trust to expedite the certification process. This mutual reliance eroded the independent oversight necessary to catch critical design flaws, leaving the flying public exposed to unprecedented risk. The safety net that was supposed to protect passengers had been systematically dismantled by economic efficiency. When the first aircraft went down off the coast of Indonesia in October 2018, the immediate response from the manufacturer was to point fingers at the flight crew. Executives drafted statements suggesting that foreign pilots lacked the competence to handle the aircraft, deflecting attention away from the underlying design flaw. Instead of immediately grounding the fleet and thoroughly investigating the software, the company issued a vaguely worded bulletin reminding pilots how to execute a runaway stabilizer checklist. The financial machinery fought to protect the product's reputation, prioritizing market stability over a transparent admission of failure. Just 5 months later, a second jet crashed shortly after takeoff from Addis Ababa, Ethiopia, under terrifyingly similar circumstances. Flight data recorders revealed that in both instances, a faulty angle of attack sensor fed bad data to the flight computer, triggering the software to repeatedly push the nose down. The pilots fought valiantly against the machine, pulling back on the yokes with all their strength, but the software relentlessly reactivated, ultimately overpowering their manual inputs. The single point of failure had behaved exactly as the compromised engineering design dictated it would. The tragic irony is that the system designed to prevent a stall actually caused the fatal dives driven by an illusion of control. When operators are deprived of critical information about how their machinery functions, they cannot accurately diagnose a crisis in real time, causing the human element to fail catastrophically. The pilots were fighting a ghost in the machine, a piece of code they were never trained to handle, reacting to a scenario that should have been physically impossible. The cognitive load placed on those crews in their final moments was the direct result of a boardroom decision to minimize training costs. The second crash shattered the illusion of safety, prompting aviation authorities around the world to ground the entire fleet, defying the initial hesitation of the American regulator. The grounding lasted for 20 months, costing the manufacturer more than $20 billion in direct expenses, canceled orders, and compensation to airlines. The economic gamble to save money on simulator training had backfired, triggering one of the most expensive corporate crises in modern history. The financial metrics that had driven the reckless development cycle were entirely decimated by the reality of the engineering failures. This disaster forces a harsh reevaluation of how modern corporations balance shareholder expectations against public safety. For years, executives were rewarded with massive bonuses for hitting production targets and driving up the stock price through aggressive buybacks. These financial incentives created a tunnel vision where the long-term viability of the company was sacrificed for short-term quarterly gains. The board of directors, tasked with overseeing risk, failed to challenge the aggressive timelines. acting more as a rubber stamp for management than a safeguard for consumers. In the aftermath, congressional hearings and internal investigations unearthed a trove of internal communications that laid bare the internal culture. Messages between test pilots and engineers revealed a deep, cynical awareness of the flaws in the certification process, with some employees openly mocking the regulator and the airlines. These documents proved that the systemic vulnerabilities were not unknown anomalies, but open secrets within the organization. The facade of a unified, safety-obsessed engineering powerhouse was stripped away, revealing a fractured company driven by fear and financial pressure. The ripple effects extended far beyond the immediate participants, revealing how market structures can amplify individual choices into global tragedies. When a company holds a virtual duopoly in a critical global industry, the normal market corrections that punish poor quality often fail to operate efficiently. Airlines cannot easily switch to a competitor when production backlogs stretch out for a decade, forcing them to remain tethered to a compromised supplier. This lack of market elasticity emboldened the manufacturer to take risks it might otherwise have avoided in a truly competitive landscape. The quest for accountability yielded deeply frustrating results for the families of the victims and the broader public. While the corporation eventually agreed to pay a $2.5 billion settlement to resolve a criminal charge of defrauding the government, the structure of the agreement largely shielded top executives from personal criminal liability. The settlement was heavily weighted toward compensating airlines rather than punishing the systemic negligence that led to the crashes. It reinforced a cynical perception that corporate entities can simply buy their way out of catastrophic ethical failures. The legacy of this collapse permanently altered the global aerospace landscape, severely damaging the credibility of American regulatory oversight. International aviation authorities, which historically followed the lead of the American regulator without question, now insist on conducting their own independent certifications of new aircraft. The cozy era of delegated authority has been subjected to intense scrutiny, forcing a recalibration of how governments monitor massive, economically vital corporations. The tragedy proved that when a regulator becomes a partner rather than a watchdog, the public always bears the ultimate cost. Today, the aircraft is back in the sky, heavily modified with multiple layers of redundancy and mandatory simulator training for all crews. Yet the systemic vulnerabilities from that era persist across the broader corporate landscape. Wherever intense financial pressure meets complex engineering, the temptation to cut corners, to hide vital information to save costs, and to prioritize the stock ticker over the product remains a constant threat in modern boardrooms. The ultimate lesson is not just about how to build a safer airplane, but about how to build a corporate structure that actually values the truth. We must continually question the invisible structures that govern the products we trust with our lives. Are we truly holding corporations accountable for systemic failures? Or are we simply waiting for the next inevitable compromise? Because understanding why it happened is the best way to recognize it happening again. If you enjoy breaking down the incentives, decisions, and systems behind corporate scandals, not just the headlines, subscribe for new investigations every week, because understanding why it happened is the best way to recognize it happening again.